beyond market headlines. To understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Taiwan index holding on to gains of almost 0.5%. On the flip side, your Hang Seng that is down 0.3%.
Keep an eye on both these two, but the Nifty Bank will have to do bulk of the hard work to take us higher from here on.
This is a great set of numbers. It's only consumer non-durables which has contracted.
We've got a positive opening, 50 points higher on the Nifty. The mid-cap index is looking even better with a gain of about 200 points right now.
Very short term, we're going to be correlated with the NASDAQ and the US markets as far as the big IT companies go.
Monetary policy has only limited potential to push up growth.
Even for state-owned PSUs, I think it will probably make it easier for them to go out and encourage collaboration with global majors.
First up today, what's actually transpired is that the FMCG pack yesterday that saw significant selling pressure on the back of favorable macro data, CPI easing a little bit.
Reiterated that the order finalization worth 12,000 crores are expected by 31st March of this year.
Not expected to suggest any changes to what has been proposed by Department of Financial Services.
Around that 22,450 mark is the Nifty. That is the level the index is fighting to defend, as it has been doing so over the last 5 trading sessions.
Good afternoon, hello and welcome. You're with us in the last hour for the day, for the week, as we're gearing up for the festivities. This is Closing Bell. I'm Surabhi Upadhyay. With me is Nigel D'Souza and Manglam Malu. And the color on the screen right now is a little bit of red. The market spent a fair amount of time in consolidation, but
yeah.
What's that?
Yeah.
That's the color. Yeah, right now we're going with that color.
Yeah.
But let's see, it's not a very deep shade of red. This light red, it's okay. I think the market can handle it.
I thought I'd just, surprise all of you guys because the color of the screen is red. We just put a little green tika.
Oh, there's some green coming in.
Yeah.
Oh, he's always prepared with something or the other.
Yeah, you got to.
A little bit,
Yeah.
It's a little. Yeah.
Oh, I put it on your face. I just thought I put it here.
It's self-holy. It's self-holy. Okay, it's self-holy on closing.
All right, so let's do that. Holy, it is green on our face and red on the screen. Nothing really to worry about. We have expiry. What's interesting is during expiry, you usually see a lot of options being written.
Yeah.
I was looking at the 22,400 put and the 22,500 call. A lot of straddles are written at the 22,450 mark as well. So the street believes that maybe this is the range that we're playing with. 22,450 call and 22,450 put. Both of them come up for you. Together, you're playing for a premium of 50 rupees, which brings the range to around 22,400 at the lower level to 22,500 at the upper level itself.
Well, that's right. Just a couple of other factors. One reason for this kind of weakness is we're going into the weekend. It's a long weekend. You don't know what's going to happen in the US markets. You have another inflation data print that comes out today. You have the jobs print as well that comes out today. And you don't know what Mr. Trump is going to go next. So maybe some weakness, some kind of profit taking. Besides that, advance tax, over this weekend, that's the last day. 15th is when you can pay it. And also there'll be an element of tax harvesting as well that's playing out. So put all this together, it could be the reason of some kind of weakness. And there's more pain in the broader market. So just want to put that on board as well. Only 900 stocks advancing, but close to around 1,700 stocks that are declining. But by the way, we had, Nimesh's D Street chatter that got confirmed. There's a big deal that's happened in Kolte Patil. We'll have Nimesh who join us very, very shortly to help us out with that. Few details that we have is that Blackstone, they are the ones that, are taking a stake. Why the preference route, I think so. And because of that, they'll be launching an open offer as well. The stock, remember, the last few days has seen a big run. The street was sniffing something is coming about. And now that's confirmed. Nimesh will be joining in to give us further details. Surabhi.
Okay, just very quickly on the large cap screen, trends are very mixed and muddled. I mean, even across sectors, it's hard to sort of pinpoint too much. But yes, the broad sort of issue that's emerging is that in consumer stocks, there continues to be some weakness in selling. Case in point would be a Lever, Britannia, Asian Paints. Most of these stocks are down. There's Tata Motors and Shriram Finance. Shriram Finance, by the way, is the biggest loser this afternoon on the Nifty. It's down about 3% as we speak. There's also selling in SBI Life. So some of the financials under the weather. If I talk about the upside, however, on financials, ICICI Bank is seeing dedicated buying, clear buying, 0.5% up. and SBI. SBI is up about 0.8% as well. So within financials, there's a bit of a divergence, but largely speaking, banks seem to be doing fairly okay. On IT as well, trends are divided. Remember, yesterday, Infosys was among the key losers on the screen. Again, Infosys is down about 0.7% today. But then you have something like a TCS, which is doing relatively better off. So basically, it's a little all over the place and fairly muddled, at least for the time being. But yes, the broader market is sort of struggling a little more because the mid-cap index is still down about 0.5%. So how should you position yourself in the last hour of trade? What are the strategies to consider? Let's ask Mitesh Thakkar. Mitesh, getting ready for the festive weekend. So tell us, last 1 hour trades, what would you do?
So I think, as you were actually saying, it's very muddled and we still haven't got any kind of trend signal on the upside. Now, failure to do that is slightly on the worrisome side, but as I said, I think, the confirmation will come once the Nifty starts breaking 22,311. Starts not happen. So it's still in that range. So avoiding the index per se. On the stock side, though, I think, there are trading opportunities both on the long and the short side. So I have sell on IRB Infra. Keep a stop at about levels of 44 here and 44.25 here. So target of around 41 on the downside, while ITC is something which I would recommend buying with the stop at 406.5 for targets of 422.
Okay, all right. Thanks a lot for that, Mitesh. We'll keep touching base with you as the show goes on. However, there are a couple of stocks that were under pressure yesterday, and they're seeing further selling today. I'm talking about Ramco as well as Dalmia Bharat. Now, the news yesterday was the Tamil Nadu government, they've gone ahead, they've imposed 160 rupee per ton limestone tax, mining tax on the limestone that's mined in the state of Tamil Nadu. Dalmia Bharat, well, they've issued a clarification today. They say that the impact is likely to be close to 130 crores per annum, which the company in all probability is going to try to pass it on to its customers. They go on to add that the Gazette, well, it's dated February 2025, but the date of enforcement of the act is not yet notified. So we'll have to keep that in mind. When exactly does this change, this 160 rupees per ton, get effective? We'll have to wait by for that. But brokerages, they had written about this earlier this morning. So let's run you through a few of them. Kotak Institutional, they said they have a sell rating on Ramco Cements. They estimate an impact of close to around 10% of their FY26 EBITDA. But they expect price hikes to partially offset these higher costs. They're hoping that there'll be a price hike that's gone about, though they have a sell call. Giving them company with a sell call is Investec. They have a sell rating on Ramco Cements. They say that given the competitive pressures and the unfavorable demand-supply dynamics that are playing out, this cost increase is unlikely to be fully passed on through price hikes. So they are not very optimistic on this hit getting pushed through via the price hikes because of the demand-supply dynamics. And Jefferies, they say that the announcement is not, specific right now to just Tamil Nadu. But there's a proposal that's already in the works in Karnataka. They also highlight that this may set a precedent for other states as well. So there could be that that effect that other states as well go in there and put in some taxes, particularly the non-BJP ruled states, because the others, they'll normally follow what's happening at the center. So explains why both these two stocks, Ramco as well as Dalmia Bharat, because of their clinker exposure to the state of Tamil Nadu. For Ramco, as we told you yesterday, 50% of their clinker is in Tamil Nadu, while for Dalmia, it's close to around 25% odd. Just put in the math, 160 rupees per ton, 50% for Ramco will be close to around 80 rupees. For Dalmia Bharat, it will be in the vicinity of around 40 rupees. So that's the kind of shaving off we'll see. For Ramco, close to around 10% of the EBITDA. For Dalmia, it could be effective close to around 4 to around 4.5% or thereabouts. Devin Chauksy of DR Chauksy joins us on the show. Hi, Devin. Good afternoon. Good to see you in, and happy Holi in advance. Well, tell us what do you make of these cement names. Both of them have pulled back both yesterday as well as today. So the street is not buying the dip. The impact could be around 5% for Dalmia Bharat, but in 2 sessions it's lost close to around 8%. What do you do?
Yeah, Nigel, happy Holi to all of you as well. Well, I think coming on to the subject of the toll tax that this Tamil Nadu government is talking about on the certain-based companies, the impact directly is onto the numbers straight away, because unlikely that I think you pass it on this particular cost directly to the customers. And should it not be the case, then in such situation, I think the balance sheet will have to absorb this kind of cost. Now, the numbers may vary from company to company depending on output that they service from respective parts in this particular territory. But yes, I think both Ramco and Dalmia Bharat, both these companies, which are predominantly, I think, out there, could probably have the balance sheet impact of between 5 to 10% as we do the rough cut calculation at this point of time.
Okay. All right, Devin, got that. That's some of the cement stocks that have been focused on the back of this royalty issue on limestone. Got that. Let's turn the spotlight on one stock that's been falling consistently, actually, not just today, even yesterday it was down, and that's PB Fintech. Let's pull this up, down about 5.5% right now. And if you're talking about the 52-week highs, and the stock's cooled off almost 40% or so. We'll get in our colleague Yash to talk about this in just a bit. Now, what happened with PB Fintech is this is something that they declared several months back, that they are going to get into a healthcare sort of a foray. And at that time, the company had made it very clear that it's going to be a very asset-light strategy. They're not looking to make very heavy investments in this. Over the last 2 days, the evening before last is when they actually announced some investments, a total of almost 700 crores that's being put to work. And the street seems to be a little perturbed about this. Let's actually hear out a view that we got from Nilesh Shah of Envision Capital. Then we'll try and get some perspective from Yash and also ask Devin what he thinks about PB Fintech. Hear out what Nilesh's view is.
Many other players in this space, hospital companies moving into insurance companies. Here is an insurance distribution company trying to kind of get into healthcare to improve the consumer experience. So I clearly believe that it's honestly not a very material kind of event. Unfortunately, the market sentiment is not really the best right now, and therefore these are probably being looked upon as markets as being some bit of a distraction kind of thing. But I honestly don't think this poses any kind of a structural headwind to their medium to long-term growth plans. And I don't see that as an issue of any serious capital misallocation.
Okay, so Nilesh at least is not too worried, and he's an investor in many of these companies, these new age digital platforms, and he said that as long as it's within the guided range, shouldn't be a bother. But let's get more perspective with Yash. Yash, what are you picking up? This is not new. They've been guiding the street on this, but what's the concern?
Well, the stocks have been telling you the big concern that is coming, from this particular development of entering the healthcare space. Just if you look at the stock, it's down 42% from its 52-week high. About 10% of that fall has come just in the last 2 days. In terms of market cap, it's lost about 6,500 crore just with that 10% fall in the last 2 days. The street clearly not liking or favoring the diversification which the company plans to do and has expressed the intention to do at this point of time. What is it? The investment of about 696 crore rupees in the healthcare vertical which the company intends to take. The analysts also that I've been speaking to, the only reason that they find at this point of time is that if insurance distribution is the core business, why are you adding a hospital chain to it? Even if, the possibility of it benefiting your core business at a later stage, but at this stage, it is a diversification which is not being appreciated by the street. What had the management said? Because that is also important to understand what is their take on this diversification. They had said that Policy Bazaar is not investing in this venture from a financial return perspective. Right? Policy Bazaar is investing from an enablement perspective, and the venture benefits Policy Bazaar and the industry a lot. So since the management is also not expecting largely in terms of the return perspective, the street watching out for that one, and then the diversification happening, certainly not the flavor that the street wants at this point of time.
Take that point, Yash, entirely. Certainly not the flavor that the street wants. Down about 10% in the last couple of trading sessions. Like Yash pointed out, about 6,500 crores eroded in market cap. Typically when we hear of companies looking to diversify, the big question of whether this is capital allocation appropriate or not does always arise. And the street answers, there are times when diversifications are supported by the street. And in bull markets, typically, these are appreciated as well. But when the market's a little jittery, money going out of the company into an area of uncertainty, the street's given its verdict, down about 10% in the last 2 trading sessions. And it's not that the stock was at a 52-week high anyway. It was weakening. What do you make of this?
Yeah, so I think on one side, we are already an asset-light model in PB Fintech, and we have moved into the portion and maintenance-heavy model. Even though I think the hard infrastructure in form of the real estate is not owned by you, which is what the company has clarified. still operation and maintenance part of the activity, which commands sizable amount of capital allocation because of the requirement of higher amount of devices in the healthcare segment, in the hospital particularly, I think is not fully understood and appreciated either, because that's not your core expertise. Your core expertise is basically to sell the insurance. And probably I think in order to give consumer a better experience, if you start operating the hospital, is not something which is ever an easy task. And that's something which one will to understand how much value addition that one will do in the entire process. If you can't produce a higher amount of value addition, then probably I think inefficient use of capital is definitely I think on the cards. And that's where I think one is little wary about. Maybe I think they have something to talk about in form of how they will structure the products with insurance companies eventually. And that's where they will get end-to-end benefit out of this entire activity. Is something if they can clarify further, maybe I think we'll get more idea to get from them. But otherwise, I think the asset-light model commanding significantly high amount of valuation on the numbers, getting into the asset-backed model, even if it is for operation and maintenance purpose, I don't think that I think justifies at this point of time.
All right, we take that point. Just hang in there because, you know, now there has been confirmation. Nigel pointed it out at the start of the show. Nimesh had told us earlier itself. It was a news break that came in on D Street Chatter where Kolte Patil has approved fundraising, preferential allotment of almost 400 crore rupees worth. And it is acquired by the Blackstone entity. Now, what's interesting is that it was just yesterday and today as well. We've been playing you sound bites coming in from the global CEO, Stephen Schwarzman, who does believe that, you know, they want to increase their India exposure to $100 billion and at the same time fairly bullish on the way real estate is playing out in India as well. And the man has actually put his money where his mouth is.
Yeah, so this is what, close to around 100 million, you know, roughly, I think so, because there's an open offer as well. So part of that money has come. Lots more has to come.
Lots more has to come. Currently, they have about 50 billion. They want to double their exposure to India to about 100 billion. So let's see how that goes.
So we'll get to Mr. Stephen in just a bit and what he had to say. But for the time being, Nimesh is joining in. Nimesh, bang on yet again. Chatter, hammer, you know, bang on. You told us in the next few days you could hear about something. And this is, I think, Blackstone's first big bet on the residential market here in India. Tell us more, Nimesh.
So exactly, you know, Nigel, we had highlighted that there will be a deal where PE will invest. So Blackstone is now, there is a confirmation that Blackstone is putting in money in Kolte Patil. So it's a three-stage, deal which they've announced today after the board meeting. One, Blackstone will do a preferential of 14.3%. So that money will go into the company. That is at 329 rupees per share. Additionally, they are buying from the existing promoters of Kolte Patil 25 plus something. So again, that's again at 329 rupees per share. That will trigger an open offer for 26%. And again, that is at 329 rupees per share. So put together 14.3% of pref issue and buying from the promoters 25% means that at least Blackstone has 40% stake in Kolte Patil to start with. And there's going to be an open offer of 26%. So whatever comes in the open offer, they will lap it up. So looks like at least to start with 40 plus whatever they get in the open offer is something that Blackstone will own in Kolte Patil. If you just look at the stock price, almost stock was at a 52-week low. So it has corrected from almost 700 all the way to 300. So I think it's a good deal from a Blackstone point of view. They're getting an entry into the Indian real estate, especially the residential real estate. So till now, Blackstone's exposure, whether through Embassy or through Indiabulls Group, was all for the commercial real estate. Now, for the first time, they're getting into the residential real estate space, buying out a majority in Kolte Patil and making an open offer as well. So that's the news. The board meeting was scheduled today, and there is a confirmation that Blackstone is now putting in money at 329 rupees per share.
All right, and Nimesh pointed out that Blackstone is going to do that. Blackstone themselves pointed out that they will increase their exposure to India. And it was just yesterday that we were, listening into Blackstone's group CEO, Stephen Schwarzman, who commented about the company's growth plan in India itself. And this is the first of the many that they will be making in terms of investments, their prospects of even data centers in India. Listen in.
We're many times what we expected to be, because the country is such a great place to operate. India happens to be our #1 performing market in the world for Blackstone. Our returns here on a gross basis are somewhere around 40% a year, way in excess of any other market. And we've spent our time building businesses in India to make India better. And we foresee being able to double where we are, to have a total exposure of $100 billion at some point in the future. First of all, Prime Minister Modi and the President had a very good meeting, which is a great start, and they agreed to have a trade agreement between the two countries. Right. And they also made some other mutual understandings, evidently, at that meeting. And so I think that the baseline for India seems to me to be very good. There's a good relationship with the two principals. There's a lot in common. There's a favorable attitude. But I think the quality of your leadership in India and the ability to reach agreements should be very good. Our biggest exposure here, we'll continue to do more, is in technology. So, for example, Blackstone is the #1 developer of data centers in the world. And we're also the #1 owner of data centers. And this is just the start of the data center industry for India. And we can see very substantial growth there as artificial intelligence becomes much more widespread. The growth numbers are stunning in the rest of the world.
All right, that's Blackstone's big bet on India, and the evidence is already there in the form of Kolte Patil. Devin, before we let you go, I don't know if Kolte Patil specifically is a stock that you've looked at. Please tell us about it if you have. But otherwise, I mean, what does this signify, this kind of investment by an international giant in listed real estate? Would there be any sort of corollaries for the other listed stocks, and which ones do you like?
So maybe, Surbi, I can possibly refer to what the company said in the last quarterly result about, I think, some value of property which they are under development, which is close to around 4,000 crores as they see it. And currently the market cap of the company is 2,500 crores. So certainly, I think Blackstone seems to have invested this money into the company, largely, I think, against the kind of receivable value that they are talking about. And should that be the case, then probably I think the stock price could have the upside from current levels. Now, as of now, the company is adequately priced. In fact, I think premium value at this point of time. So not immediately sure whether I think one would get the immediate benefit. But as the Blackstone's, I think, theory would go, probably even if they get 15% IRR, I guess I think they would be happy to get this kind of investment done. Maybe calculation seems to have happened on that number. Let's see, I think, how exactly we break the numbers up and then see. But this is what I think I gather from the news that we have heard so far.
Okay, all right. Devin, thanks a lot for your quick comment on that. Wishing you a happy Holi in advance. We catch up next week with my co-anchors because I'm not there. But looking forward to seeing you soon. Well,
Thank you, Nigel. Wish you all a pleasure as well.
Thank you. Thank you, Devin. Well, time to slip into a short break. On the other side, we have Amit Jaswani from Stallion Asset, who's waiting for us. He's going to comment on the markets and how he's churning his portfolio. You don't want to miss this.
Welcome back. Must point out that the color now is becoming a little deeper shade of red, both on the Nifty and the mid-cap index. Both these indices are at the lows of the session. It's been choppy, but now it seems that the bears are having a bit of an upper hand. 76 down on the Nifty, and the mid-cap, there you go, down a little over 0.5% at this point. Before we carry on and welcome in our next guest, here's a quick update on the US indictment of Gautam Adani. The Indian government has asked a sessions court in Ahmedabad to serve summons to Gautam Adani and others over allegations of bribery and concealing information from American investors. India and the United States are signatories to the Hague Convention. The Hague Convention allows signatory nations and countries to directly request an agency in each other's countries for assistance in serving legal papers. The Union Law Ministry wrote to the Ahmedabad court asking it to serve the US summons on Gautam Adani and others. The letter is dated the 25th of February. This was first reported by The Hindu and then later confirmed by CNBC-TV18. So that's just an update in terms of how the legalities are shifting in that case which has been lodged in the US. Moving on now, let's welcome in our next guest on the show. Amit Jeswani, founder and CIO of Stallion Asset, is joining in. Amit, are you already all set for the Holi party? Okay, we've still got you in office, so I guess, yeah, still working. But tell us, I think this Holi, the only one color that the market has shown people is red. When will the green show up?
Hi, Surabhi. Good afternoon. Thank you so much for having me on your show. I hope it comes soon. The green color, that's all I can say. But it's going to, see, the bear market's been very painful, to be honest. We've also lost money. No one can be spared in this kind of drawdown. We've also lost some money, but the thing is that you have to survive, and those who survive this bear market will be very rich in the next 2 years again. It's the same cycle. If anyone stays in the market for 5-10 years, survives the bear market, makes it large in a bull market, you end up doing okay. And in fact, you end up doing very well. You just have to survive these times. Don't be super extra, like this is what I'm trying to do. I don't know what is right or wrong, but I'm trying to, we've come on some cash, we've taken some defensive bets. We are just chilling for now. We have nothing to do because there's no new trend which will come. Don't just average down the winners of the previous cycle.
No, Amit, exactly. Amit, allow me to come in over here. And I'm just saying this for the benefit of viewers who might not be fully aware. I mean, we all know that you have followed the whole growth investing philosophy to the T, and it's worked wonderfully well for you and your investors, right? You've had some of the highest growth stocks, high momentum stocks in your portfolio, and that's been your stated investment style. Have you changed that approach, given that now this has become a 5-month-long correction, not a quick V-shaped one?
So actually, our portfolio started falling we made lifetime highs in December, and only in January our portfolio started correcting. In fact, from October to December, we were up, I think, 5-6% when the benchmarks were down. In December, we started falling. January, we started falling. And Feb also, we fell. But have we changed our stocks? Keep changing. The style doesn't change. We will still chase momentum of earnings growth. We see market chases predictability of earnings growth. And market hates uncertainty. Right now, the markets are falling because there is uncertainty of trade wars and tariff. The day the uncertainty ends, even if tariff is 30% or 20%, nobody cares. It's just that uncertainty event should get over. See, the day lockdown was announced, that was the next day the markets bottomed. The day the Fed in 2020, the day the Fed increased the interest rates by 75 bips, on 15th June 2022, that was near that day, the markets bottomed. If you think about it, demonetization and Donald Trump coming in 2016, like November 2016, when Donald Trump, on 8th November 2016, when demonetization also came and Trump also came, that exact day, markets bottomed. So market hates uncertainty, and markets loves predictability. So the markets will be 20% tariff, whatever it is. The 2nd April should just finish. Once an event finishes, the markets readjust, and stocks which are not getting impacted, they will start rallying. And where there is predictability of earnings growth, and where the valuations have got cheaper. So the first phase will survive. Because in a bull market, you do end up making some mistakes, but only later you realize that these were mistakes. Like when you're buying it, you don't come to know these are mistakes. Only later things change. There is new competition, which is...
So, Amit, I just wanted to understand a couple of things. From the peak, what has the drawdown been in your own portfolio? You said you've raised some cash. So what kind of cash are you sitting on? And the third part, what have you entirely exited and what have you made fresh entries into?
So our drawdown's been around 18%. So from near our lifetime highs, we've fallen around 18%. I don't know exact numbers, but broadly, I'm telling you, from our broadly around these, it can be 1% lower, 2% lower. I don't know, but around 18%. I think today it was 18% today morning. That is our fall from this thing. I think that is in line with the benchmarks also. About what we have done, see, wherever we've seen new competition coming in, be it food delivery, be it, we've trimmed those kind of positions. We had one exchange in our portfolio. We've sold 95% of that. Wherever other promoters have not delivered, we've said bye-bye to those promoters. Whoever's executing, we're still holding in our portfolio. So we are 80% invested. The next investments that we'll make, we've already made 2 investments in financials. We've made financials near 10% of our portfolio. Financials as in lending 10% of our portfolio. So we are moving slowly towards new trend, new cycle, new portfolio.
What about the cash levels, MS?
The next
cash yeah. Go ahead, Amit.
The next leaders, Nigel, will be very different. And we don't know. So typically, all bear markets, from Harshad Mehta's bear market to every bear market has lasted between 9 months to 12 months. On Nifty, on small cap index, it might have lasted 18 months also. But in Nifty 50, if you go history of last 30 years, I'm just giving you data, that all bear markets last between 9 months to 12 months. I don't know, because this is the first bear market where you're falling 5 continuous months. Even in 2008 bear market, you were not falling like continuously 5 straight months. You were falling 3 months and then two months of dead cat, etc. But that's not happening in this bear market. There is no dead cat. In fact, there is new dead stocks every day. So it's a tougher kind of bear market to survive in.
Okay, all right. Hi, Amit. Good to see you in. So 18% drawdown from the peak is what y'all have seen, and also the cash in books is around 15 to 20% is what you said. Is that correct?
It's 20%. Around cash plus liquid DS, like liquid fund.
Liquid fund. Got it. Got it. Amit, what about how are your clients behaving? I recall in the bull market, you all did very, very well. They were so used to saying, Amit is giving us splendid returns. Now what are they saying? Amit, show us the money. We're giving you more money, or we're packing our bags and saying bye-bye Tata, like how y'all are saying to some of those promoters.
God's been kind for us. At least our customers trust us a little longer. So I think we had very recent inflows. And I don't know, I don't look at those inflow numbers, but those are very large numbers. I think it was the largest in the industry, but that is not my focus area. My focus area is performance. These numbers are, in fact, we have increased our ticket size 10x because we are not chasing inflows, to be honest. We are already at 4,000 crores. We want to focus on performance, not A1.
No, the point I wanted to get at, Amit, was that y'all are seeing inflows, which is good. The numbers... Strong inflows. That's good. That's showing you that people still have a lot of faith, a lot of interest in the markets, and they believe the pain is coming to an end. That's the sole point I was trying to get at.
I wouldn't say that they believe the pain is coming to an end, but they know that if like we do, like they're just betting on us. I think the pain will take some time, and we're telling our clients also it will take some time. And is when you're going in a bear market after a long time, it's not like bear markets end in 5 months. It may take some time, but it's okay. There'll be a bear market, there'll be consolidation, and then there'll be a bull market. Our job is not to predict beyond the point markets. Our job is to be with the companies, the best 25, 30 guys who are executing, scaling.
Amit, splendid. And you've been quite vocal as well. At times, you give us a few stocks. Don't disappoint us this time, Amit. Tell us one of those big bets that you'll have taken, 1 or 2 of them. It may or may not work, but something that you'll have conviction. Due disclosures come up for our viewers on the screen as well. But this could be a stock that Amit believes, 1 or 2 stocks that will do well from here on.
You did hint at a couple of financials that you've
added.
Those are like my protection bets. I wouldn't say, because my cash would go to 30-odd%. So those are not super, like I'm not.
Okay, so for now, capital protection bets, if you can tell us, and then after that.
The growth bets.
Both are NBFCs, the market leader in consumer finance and the market leader in gold finance. These are 2 new bets that
so Muthoot and Bajaj Finance. Let's keep it simple.
Okay, so that's on the protection side of it.
For protection of capital. I don't know how much money we we bought the breakout. So see these stocks, if you think about 2018 rally, see, we are studying bear markets, we are studying books, what to do. There's nothing to do with market.
So, Amit, I'll tell you this. I heard you very carefully. I've been holding on to every word. Before we talk about your growth bets, you made a statement. You said, and acknowledged very with a lot of humility, that in every bull market mistakes are made. You realize them in a bear market and you correct them. What's the mistake you realized that you made in the previous bull market that you've corrected now?
So many. See, actually, these are not mistakes. Things change.
Which I don't know if it's a stock mistake or if it's a style mistake. Yeah,
no, style is not a mistake. Style will also keep evolving. I'll tell you. Zepto started burning a lot of money very aggressively, and Zepto came from nowhere because from November they started raising a lot of money, and Dipender also spoke about how they have burned 2,500 crores. Of course, they denied it, that they don't burn 2,500 crores, but they are burning decent sized money, and competitive intensity in sectors are changing. Today, exchanges are fighting like I cannot even imagine. Not that we sold exchanges at very good prices, but I'm just telling you, in cola wars, that's happening. So in consumer companies, which were part of our portfolio, they've started to have very strong competitive intensity. And when you have, Peter Lynch used to say these things, that in all failed companies have only one thing in common: they fail to escape competition. Monopoly is the only condition of every successful business. This is 0 to 1.
Okay, on consumer, we're running short on time, so I'm just going to quickly spam you with 2-3 very specific questions. You've realized that there is a lot of heightened, competition in the consumer space. You love Trent. You made a lot of money on Trent. I think you even had Zomato for a better part in your portfolio. What have you done with these big names? That's a question that a lot of investors, even investors beyond your fund, they're all asking the same question: what to do?
These stocks are a very small percentage of our portfolio today. What they used to be? They used to be extremely large percentage. At one point of time, both would be around 16%. Right now, they are, I think, less than 5%, but I don't know exact, but broadly even less than 5%.
And what are you going to replace? So these were your growth engines in the previous booming bull market. These consumer stocks, they were giving great growth, right? 50, 60, 70%. So what will you replace them by? Getting back to the original question, what's the new growth engine?
So I can tell you the pattern. It's the leader of the bull market is not formed 5 months in the bear market. Typically, it takes some time for newer leaders to get formed and let the newer earnings season come. But they will have high growth, initial low valuation. When we bought a Zomato or a Trent before Pele, the valuations were free. Like today, like we bought at 25p, 30p kind 1 year forward valuations. We don't initially buy at very high P's. We buy at low P's only, which is 1 year forward low P. We make a lot of money because that is how, if the stock is growing at 40, 50, 60%, of course there's going to be a bubble. That's how markets work. In 2027, again, if a stock is growing at 40, 50%, it will trade at 100, 150, 200 P's, because every bull market from last 200 years, for last 30 years, be it tech bubble, be it any bubble in history, it has happened because of very high growth and very high, it gets very high P multiple. Again in 2027, in a newer bull market, there'll be newer stocks. They will initially start very cheap, and you have to play them, make money. You have to make money. This is how markets work. We have to work with. Sorry, I stretched.
All right, Amit, very quickly, IGI, something you'll had totally out of it?
We sold majority of it.
Sold majority of it. All right, because that was something that had a small part of your portfolio. They disappointed on the numbers, and you said, yeah,
no, we sold even before numbers and after numbers both. So we keep doing this. And we can buy also. So
and why did you sell, Amit? Just to understand, why did you sell? Do you think that the certification business for lab-grown diamonds won't have that kind of margin? Do you think why did you sell IGI?
So first is risk management, which made us sell because we had to cut down our allocation because our risk triggered because of pricing. And then because lab prices went lower to near lab-grown diamond prices, that wholesale market prices are now less than $100 that we know, that we speak to dealers and vendors. So even though diamond market will become large, certification may or may not become large. And these are emerging monopolies. In a bear market, see, everything changed in January, February. In a bull market, you chase only next 4 quarters of earnings. You don't think too much. If you think too much, you will not be able to make money. Your job is to make the highest money. In the bear market, your job is to protect capital and survive. So in bear markets, the guys which don't have very strong terminal value you want to cut weights because the first companies to start a new bull market will be the ones who have very large terminal value.
Right.
And
Just a final word, Amit. In bear markets, investors also say that it's the time to find bets, right? There are people who are greedy when the markets are full of fear. Are you finding anything where you earlier passed on because of valuations and now valuations are palatable and at the same time there is still visibility of growth? Is there any of those things on your portfolio right now?
They also we were buying so many names. We are decreasing allocations in newer kind of names all the time. So our game will keep going on. And I have nothing against IGL. If IGL starts growing again, or any company, if Zomato competition intensity decreases, we'll increase weights. We have nothing against any company. We are just we are just investing in our own patterns. As long as we have that clarity of our patterns, that what works, what doesn't work, we will keep doing that across. And today also we are buying companies. Not like I don't want to be in cash. Cash is not a position, it's an outcome. If I'm not getting stock ideas, I'm not going to force myself into a position and then lose money.
But still a growth chaser, right? That remains the core, the heart of your philosophy. You'll buy growth.
Buy predictable growth. So right now, predictability is more important than the highest growth rate. Given a 60-70%. So it depends on market conditions, Surbi. You develop your style that what works in what market conditions. And right now, I would choose predictable growth over...
And not just growth.
So I think the biggest difference between the bull market and the current market for him is earlier he would like growth and now it's
just growth. Predictable growth. I think that sums it up. That really sums it up. Okay, all right. Thanks very much, Amit. Good one. Thank you for fielding all of our questions and look forward to having you back again soon. Well, with that, let's move on. Time for some D-Street chatter. We have Nimesh joining in as always. He's been extremely busy, and of course, a lot of his chatter is always coming through, including that big deal with Kolte Patil. What's the latest? The color this Holi is still red, Nimesh.
Well,
and congratulations on that big break, by the way, the Kolte Patil break.
Thank you, Surbi. So from a market point of view, I guess it's extremely range bound, but there is not much activity as well. Out of the truncated week, the flows are quite muted as well, is what I understand. Even the retail participation seems to be on the lower side today. From an institutional point of view, the sector which is seeing a bit of buying interest is oil and gas stocks. So HPCL, BPCL, ONGC for that matter. There was a Morgan Stanley tactical buy as well on ONGC today. So that's one space which is well bid, is what I understand from a flow perspective. On the downside, watch out for 21,800. We are still far away from there. That could be a big support to watch out for on the downside. But given it's a truncated week, the flows are quite muted today, and there is not much institutional flow as well, barring some buying, as I said, in the oil and gas stocks.
All right, Nimesh, Amit was just speaking about predictable growth. We don't know about whether growth is predictable or not, but the stock tidbits that you give and the insight that you give is predictable. So anyone who's chasing that, they will always be better informed and ahead of the curve. So what stocks have you brought for us today?
Well, Mangalam, you're just putting much pressure on me to just deliver, and it's not easy. So you take it with a pinch of salt. A lot of my stuff go wrong as well. So, we just claim on the right stuff, but there are things which go wrong as well. Anyway, the first stock on my list today is Jubilant FoodWorks. That's the stock that you track, Mangalam, very closely. While the stock has been consolidating with a negative bias, the stock has corrected from the peak. There has been some positive, brokerage notes as well of late. But the sense I'm getting is there could be a block in Jubilant FoodWorks very soon. Not a large one, close to 1 to 1.5% equity is what likely to change hands in Jubilant FoodWorks very soon. So that's the first stock. The second stock is Indostar Capital. Within the NBFC, small NBFC space, last couple of days, this stock has actually ridden pretty hard. The volumes have also picked up as well. I understand some large HNI investors have turned very active buyers in Indostar Capital. So that is the reason why you're seeing a bit of action in Indostar of late. The third stock is Kotak Bank. While we all talk about IndusInd for the last couple of days, looks like there's a bit of shift happening now to other private sector bank stocks from a flow perspective, and Kotak Bank stands out. So for the last few days, there is institutional buying happening in Kotak Bank, and one leading long-only fund has turned active buyer as well in Kotak Mahindra Bank. So that's the third one. And the last stock is BSE. The stock is in an F&O band, so only can buy in cash. There is a bit of cash buying happening in BSE in today's market. Remember, even this stock is corrected very sharply, all the way from 5,400 to almost 4,000 now. But for BSE, watch out for if there is any change in terms of they changing their weekly expiry date. So maybe that could be the next trigger to watch out as far as BSE is concerned.
Okay, all right. Nimesh, thanks a lot for that. See you on Editors Roundtable in the next 20 minutes or so. For the time being, we slip into a short break. You come back. Lots more market talk on the other side.
Welcome back. Of course, you're with us on Closing Bell. Let's look at some final trades now. Mitesh is joining in, and as we're tossing it across, there's still that element of volatility. The Bank Nifty is flat, minor gain over there, 12-13 points. But for the rest of the market, it's been a slightly weak second half. Mitesh, what's the final advice, index levels to keep in mind, and of course, final stock advice as well?
So index levels will be on the Nifty, it's 22, 300, 650 kind of range. And on the Bank Nifty is about 47, 900, 47, 880 zone. Both of them have not been validated on an hourly closing basis, and we've not got a good bounce back from there as well. So still a market which I would say is slightly tricky. Stock side, STBT on KPIT Tech with a stop at about 1220. And look at a target of around 1180, 1175 kind of a level. And a BTST on Malappuram, which is just trying to break into fresh swing highs. Actually, it should be a buy about 209. I was hoping it will get there. Buy about 209, maybe if not today, then Monday. Keep a stop at about 205 half. Look for a target of 218.
Right. Mitesh, just before we let you go, is there anything that chartically explains the kind of move that we're seeing on Kalyan Jewellers? Kalyan Jewellers has actually recovered a fair bit from the lows, currently has moved to the high point of trade as well. And it has been a stock which has been under pressure. So is it just one of those bounces from a fall, or is there any support level that it hit?
So, Mangalam, I think last time, we saw the stock once it started correcting from 800 kind of levels. The first low was around 440, 438 zones, which is where which was in the January end last week. And then we got a similar bottom around 3rd of March. Then we had a breakdown, and now looks like a pullback to me. I think once we start closing above 440, 442, we'll look at some kind of reversal. Till then, I think it's still a negative chart for me. It's not happening today. Let's see if it happens on Monday or Tuesday. But as of now, no sign of a reversal. Only about 441, will turn positive on the hourly and 2-hourly charts.
All right. Thank you so much for joining in. Once again, Mitesh, wish you and your family a very, very happy Holi. We'll speak on Monday as well. With that, let's get you among the top Nifty gainers today. We have BEL. The company is won a near 2,500 crore rupee order. Upasna joins in with more. Upasna.
Well, the defense major BEL continues to remain in focus today. Now, the month of March has boded well for the company in terms of order wins. And mind you that the company is marching towards its FY25 order inflow guidance, that is of 25,000 crores. Now, company has received yet another order, which is a significant one, for fully indigenous Ashwini radar from Indian Air Force worth nearly about 2,463 crores. Mind you, BEL order inflows till now is around 7,200 crores in Q4. Now, company in Aero India conference has reiterated order finalization worth 12,000 crores are expected by 31st March is what the company has indicated. Now, if we look at the order inflows till now, is nearly about 17,000 crores versus 25,000 crores guidance given by the company as stated earlier. And if we look at the valuation of the stock, it currently trades at a PE of 27 times FY27 EPS. Now, the key focus is that the company has said that diversification of its book has been the key focus of the company, with a medium-term goal of getting 25 to 30% of its revenue mix from non-defense segment is what the company had highlighted. Now, after this order win, Phillip Capital has maintained ad rating on the stock with a target price of 390 per share. Now, Nomura has also indicated that the company is on track to achieve its guided order inflows, and companies in the final stages of multiple negotiation with the customers is what they are seeing. So all in all, we are seeing the stock surging in trade today, but right now cooled off from the day high.
Okay, all right, Upasna, thank you very much for that. Well, with that, we do have to take a very quick break. And as we take that break, here's some good news for our viewers. India's business news leader is now just a click away, introducing the CNBC-TV18 all-new app. You can get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. Download the CNBC-TV18 app now from the Apple Store or Google Play. You can also scan the QR code on your screen.
Welcome back. As expected, the Nifty is holding on to the lows of 22,400. Yes, we briefly dipped below that. In fact, we went all the way down to 22,378, 22,380. And now from there itself, we've seen some recovery for the Nifty to hold above that 22,400 mark. What is the stock that is leading that recovery? It's HDFC Bank. It's still in the red by about 0.25%, but from the lows, there has been some recovery on that stock. What's pressurizing the Nifty, however, is Reliance, which currently is at the lower end of today's trading range so far. Divi's Labs also is one which is lower, and as we speak, we're seeing some selling once again in a couple of these real estate names. So pull up something like a macro tech developers, that's at the low point. We have, DLF should come up for you on the screen as well. In fact, the entire realty index comes up for you. Yesterday we did see some relief rally in a couple of these real estate names only because of post Mumbai or Maharashtra budget. So Mumbai-based realtors were doing well, but now as we speak, the real estate stock at the real estate index at the low point of trade, even as the Nifty's holding on to 22,400. We have the mid-cap index, which is down about 0.8%, 1,800 stocks in the red. So the red and green lines are very wide apart right now at the widest point that we've seen, with the distance between the red and the green being highest, the red much above. Good time to welcome in Ambarish Baliga as well. Ambarish, as we close for a long weekend, is there any stock that you like after this correction?
Hi, Mangalam. Today's stock is Voltas. It's a Tata Group company, leader in cooling and refrigeration products. They're in both the segments, B2C as well as B2B. Have a 20% market share in room ACs. And Voltas Beko is their international JV. And they've done backward integration, got PLI benefits also. And overall, if you look at the Q3 performance, it was quite strong. Revenue was up about 18%, margins improved by 180 basis points. And generally, Q3 is a low season for Voltas and all the AC and refrigeration companies. However, from a performance point of view, it was extremely good. So expecting a heat wave this summer, and which again should be extremely positive for the AC and refrigeration companies. So Voltas also should really benefit out of that. And looking at an EPS of about 35 for FY27, my target price is about 1680.
All right, 1680 on Voltas. In fact, incidentally, as we speak about Voltas, another consumer durables maker itself saw a bit of a spike, and that's Eureka Forbes. That stock has surged about 3% right now. Off lows is about 5%, and it's done well this week. It's going home with gains as against a lot of stocks which are seeing sharper cuts. And this month itself, it's up around 6.5%. Yes, it has corrected about 20% from its highs, but nothing really to worry about. Eureka Forbes is the one that I'm talking about. Do you have a view, Ambarish, on Eureka Forbes?
No, in fact, I don't track Eureka Forbes, so no view on that. But if you're talking of overall the consumer durable market, I see a decent sort of a recovery starting from Q1 FY26. So I think one should start lapping up at this point of time, because most of these stocks have corrected along with the market, but could be the ones leading the market on the recovery.
All right, we'll keep it short then. Thank you so much, Ambarish, for joining in with your stock pick, Voltas, that it is, and you like the consumer durable space itself. We wish you a very happy Holi. We'll speak to you in the next week itself. Let's start wrapping the week down. For this week, it was a bit of consolidation that we saw. The Nifty is going home with cuts of almost 70 points, holding on to the lower end of the expected expiry range at around 22,400 itself. For the week, the Nifty is down about 0.75%. The previous week was a positive one. What was the index that lost the most this week? It was the Nifty IT index that lost about 4.5%. So that's the one that really dragged the frontline index. We did see some, outperformance coming in from a couple of other indices. The financial services index gained about 0.66% this week. So today as well, the decline wasn't as much as the other frontline indices. The mid and small cap indices actually were the ones that saw a fair amount of cuts. This week, the mid cap index was down about 2.25%, which basically reversed all the gains that it made in the previous week. The small cap index as well, which the previous week was up around 5%, goes home this week with a cut of 4%. Today specifically, the bigger losers or the bigger draggers were, a couple of these names like Shriram Finance. We saw Hero MotoCorp lower, IndusInd Bank lower, and some selling in the IT space as well, with Wipro being among the top losers. Among the gainers today, a few of them, we had SBI did well, and BEL, which gained about 1% on account of some order wins that came by to the tune of 2,500 crores. From the broader markets, PB Fintech, for the second day running, was the stock on the downside, down about 6%, Bharat Forge down about 5% as well. On the way up, we saw some purchase in names like Avenue Supermarts and Varun Beverages. All in all, a weak day for the mid-cap index and the small-cap index, where the Nifty was contained by its losses around the lower level of 22,400 itself. The Nifty Bank outperformed this week. With that, we wrap up on this edition of Closing Bell, this week of market coverage. Wish you all a very happy Holi, and at the same time, ask you not to go anywhere because it is Thursday. We will take a short break. On the other side, our weekly special Editors Roundtable comes up next.